The question I'm getting asked more than anything right now is, should I fix my mortgage for 2 years or 5 years? And in some cases, should I even consider a tracker? It's a great question, and the honest answer is the markets are giving us some really useful signals right now. So today, I want to walk you through what's actually happening, what it means in plain English, and how you can use that to make a better decision for your own situation. Let's start with swap rates because this is where it all begins. When a lender offers you a fixed rate mortgage, they need to go out into the financial markets and secure that money at a fixed cost. The rate they pay to do that is called a swap rate. Think of it as the wholesale price of your mortgage before the bank adds their margin on top. So when swap rates go up, fixed mortgage rates go up. And when swap rates fall, lenders can start offering better deals. They're the engine behind the rates that you see on comparison sites, and most people just never look under the bonnet. Right now, there are two numbers that I want you to pay attention to, and it's important that you understand that the following rates were at close of business on Wednesday, the 19th of March, 2026, and these rates change constantly throughout each and every day. The 2-year swap rate was sitting at 4.199%. The 5-year swap rate is sitting at 4.088%. The 5-year is lower than the 2-year, and that's really important. That's what's called an inverted swap curve, and it doesn't happen all the time. When it does, it's telling us something. To understand why the curve is inverted right now, we need to talk about what's happening in the world. Because this isn't just abstract economics, it's being driven by real worldwide events. The Bank of England base rate is currently on hold, and there is no intention that rates are going to be cut right now. And a significant part of the reason for that is what's happening in the Middle East, and specifically the conflict involving Iran. When conflict escalates in that region, oil prices go up. When oil prices go up, energy costs rise across the economy, and that feeds directly into inflation. And inflation is the one thing the Bank of England cannot afford to ignore. So even though the broader direction, the longer term trend, is still pointing towards lower rates, the Bank of England is sitting on its hands right now because the near-term picture is genuinely unpredictable. They're not going to cut rates and then have to reverse the course 6 months later because oil prices have spiked. That would be deeply damaging to their credibility. And that's why the 2-year swap rate is elevated. The short end of the market is pricing in real uncertainty for the next 12 to 24 months. Nobody can tell you with confidence exactly how this plays out. But, and this is the crucial bit, look 5 years out and markets are still pricing in a world where rates are meaningfully lower than they are today. The direction of travel hasn't changed, the path there has just become a lot more complicated. And that's the inversion. Short-term uncertainty pushing the 2-year up, longer-term confidence in lower rates pulling the 5-year down. Let's talk through the 3 different options that we mentioned at the start of this video because they all look quite different right now. Let's start with a 2-year fixed. A 2-year fixed gives you certainty for the short term and then the flexibility to remortgage when your deal ends. In theory, if rates do fall over the next couple of years, you'd be able to take advantage of that when you come to remortgage. But here's the problem right now. The 2-year swap is elevated because of near-term uncertainty. That means 2-year fixed rates are pricing in all of that geopolitical risk and the Bank of England being on hold. You're paying a premium for short-term certainty in an uncertain world. And if Iran, oil prices, or some other shock keeps inflation sticky for longer than expected, rates might not be dramatically lower in 2 years anyway. So you take the shorter term, pay more for it, and potentially remortgage into a market that hasn't moved as much as you'd hoped. And don't forget that as most lenders charge a product arrangement fee, you'll also be paying this twice. So not only will you potentially not have saved on your mortgage, you'll also cost yourself more money by paying 2 product fees. Now let's look at the 5-year fixed. The 5-year swap being lower than the 2-year means lenders can price 5-year fixes more competitively, sometimes at rates that are cheaper than their 2-year equivalents. That's unusual, and it's a direct product of this inverted curve. 5 years also gives you a longer runway. You're looking through all the near-term noise, the Iran situation, the Bank of England being cautious, any further geopolitical risks, shocks, and locking into a rate that the market is actually pricing as better value than the shorter alternative. For anyone who wants stability, who knows they're staying put, and who doesn't want to be checking rates every 6 months, the 5-year is making a compelling case for itself right now. And then lastly, let's consider the tracker mortgage. Now, I want to be really clear here. This one isn't for everyone, but it's worth talking about. A tracker mortgage follows the Bank of England base rate, usually at a set margin above it. So if the base rate falls, your monthly payments fall too, automatically. No remortgaging required. If you genuinely believe, as the markets do, that rates are heading lower over the next few years, a tracker lets you ride that down without being locked into a fixed rate. Every time the Bank of England cuts, you benefit. The risk, however, if rates stay higher for longer, or even worse, increase, if the Iran situation escalates further, if inflation surprises to the upside, if the Bank of England keeps its finger off that cut button, your tracker rate stays elevated or increases too. There's no floor, no ceiling, no protection. Your payments can move up or down, and you have to be comfortable with that. Some clients are absolutely fine with that uncertainty, especially if they have some financial buffer or they're not stretched on affordability. For others, though, that unpredictability would be genuinely stressful. Now, there's no shame in saying you want to know exactly what you're paying every month. That's what fixed rates are for. There's no universal answer as to which one's right for you, and anyone who tells you there is isn't giving you advice, they're giving you a guess. What I can tell you is this: if certainty matters most, 5 years is making a strong case right now. The swap curve is pricing it as better value than 2 years, and you get a longer period of stability in a world that feels anything but stable right now. If you think rates are heading down and you can stomach uncertainty, a tracker deserves serious consideration. You'd be betting with the market, not against it. And if your circumstances might change in 2 years, for example, you might be moving, you're selling, your life looks different, then flexibility might matter more than the rate. And a 2-year or a tracker with no early repayment charges could be worth exploring. The key is getting advice that's tailored to your situation. The swap rates tell us the story of what markets expect. Your broker, and that's where I come in, helps you apply that story to your actual life. If you've got any questions or you want to talk through which option makes sense for you, drop me a message or comment below. And as always, if you found this useful, please do consider subscribing. Take care.